Hey, what's up guys, Michael here. In today's video we will be talking about the VWAP indicator. And if you don't know what it is, the VWAP is the indicator that is mostly used, I think, used in trading with stocks. So this is the topic of today's video, and of course I made some presentation for you, so I could keep up with the topic and it would be more fluent and more understandable for you to get the idea what it is. So let's start from the presentation, and we have the overall, it is volume weighted average price. So as you most likely are get the idea, it is some kind of moving average that has a volume in it, in its calculation, and you couldn't be more right. So what it is? It is basically an intraday indicator, so it is refreshed each session, and you can only display it on when trading on 1 minute, 5 minutes, 15 minutes time frame, the intraday time frames. So it is used. Why is it popular? Well, it is used by hedge funds and financial institutions to identify the moments to enter or exit the particular trade on a particular stock. So, for example, there are moments when you are a hedge fund or a financial institution, you are building a portfolio. So part of your trading are short-term trades, part of there are long-term trades, and for example, you would not like to the price to deviate so much from the VWAP, therefore not exposing your positions too much. So you would try to, if you want to sell or buy such a particular stock, you would not you would like to be incognito while doing this. But I will talk about it a little bit also later in the video. And as the thing that you are most likely waiting for, it can be a part of a trading system, the intraday trading system, but it will work in opposite way as in the daily trading as for the hedge funds, or for example for you, if you would like to build your portfolio or determine your build your strategy and for the mid and long-term trades using, for example, the VWAP. So how it is calculated? The calculation is very easy, so it will be no problem to discuss that in the first video. So as you can see, VWAP equals the sigma of the volume multiplied by price and divided by cumulative volume. So for example, now let's switch to the spreadsheet, a blank sheet, and let's calculate it. Let's calculate some example, but first give me a second. Okay, all is correct. Okay, so we have a blank sheet, and now let's make a simple example. So let's say for the first 5 minutes of the trading session we have 3 transactions, 3 clients. So for example, the first person bought 100 shares for $11. Sorry for my drawing skills. The second person bought 500 shares for, let's say, $9. And the third person bought 250 shares for $7. Okay, so let's calculate it along with the formula, right? So we have VWAP equals sigma of, this will be 100 times 11 plus 500 times 9 plus 250 times 7, and it will be divided by the cumulative volume, which is sigma of the total volume, which will be simply 100 plus 500 plus what? Sorry, would be 250. So that equals, and now let's take the calculator. So the VWAP equals 7,350. Oh, this pen tool is 7,350 divided by 850. So it is 865. So that would be our VWAP for this transaction. Therefore, it would suggest that, for example, this client paid too much, this person paid too much, but this one paid a relatively good price. And yeah, now let's switch back to our presentation. And now let's talk about the charts. Okay, so we have the chart, and we see the VWAP. This is this blue line, and I am using for this example to explain it to you the TradingView platform, and this is the Microsoft stock chart. And this is a 1-minute chart, and where you can of course add this indicator, the VWAP on your chart. You go to the indicators tab, just type VWAP, and it is a built-in indicator. So we talked about the calculation, and you see that it is more or less kind of a moving average line. What it indicates you, this is the beginning of the session, and so therefore it is refreshed each and every day, and it indicates you that when the price is below the VWAP, so the stock is relatively cheap. When the price goes above the VWAP, it indicates that the particular stock at the moment is relatively expensive. So you can also use it for the long and mid-term trading, but you need to change the anchor. When you have at your brokerage, most likely you will just see the intraday, the line. If you go to the intraday, which is only set to refresh each session, and you will see it only when you use the lower time frames, like 1 minute, 3 minutes, as you can see over here. But in the TradingView platform, or I don't know, maybe in other platforms too, I think yes, but I don't know, I didn't check them. You can also set the anchor for your indicator. So basically you need to change the anchor period. So you basically change the setting when the data from the indicator are refreshed. So you change from one session to a week, month, quarter, or year. Because if you, for example, change the time frame right now for a daily time frame, you will see that it shows no data, because one candle is one session. Therefore it just shows you, just follows the candles, because you would need to go for lower time frames to see how it performs during the day, but from this you will see nothing. Therefore you will have to change the anchor. You go from for example, a year time frame, and then the indicator is refreshed each year, and therefore you will see how each year the stock performed based on volume and the price, and therefore you can decide how to implement it into your strategy. So this is an example how you can use it for long and mid-term trades when you, for example, building a long-term portfolio, or you are just have some money that you are using for mid-term trades to go hop on a trade for a week, I don't know, a month, or just a couple of weeks. Set the stop loss, take profit, and forget about the trade. So that is the first thing. Let's go back to the presentation. So the basic difference between the VWAP and the moving average is that the moving average shows you the price, how it changed, how it performed over a particular period of time, but it lacks the data from the volume, which the VWAP basically when it has the volume, it shows you the real supply and demand, and basically it is more accurate thanks to this ingredient in calculation. So next, what it tells you. So how you can use it, we talked about it briefly, but the hedge funds, as I said in the beginning, use it to determine the moments when they want to go in or go out of a trade. But when you are a hedge fund, you don't want to expose your positions to other participants of the market. Therefore, it could be used against you. So they are using, for example, the VWAP to try to go stealth and to push the price, to when they are selling, not push the price too far from the VWAP, and when they are buying, for example, not to push the price too much above the VWAP. Therefore, you know, staying incognito, being stealth on the market, so their position is not in danger. And the other thing is that, for example, when they are building long-term portfolios for their clients, for example, mutual funds are using the ratings from the ratings agency, and when they, for example, need to sell some particular stock because the rating of this company was changed, and therefore they cannot have this company no longer in their portfolio, they also need to sell this asset. And of course, they do not want to, sell it cheap, but sell it at the best possible price. And as we talked about, to use it in creating your midterm and long-term portfolios, so you can use it in the same way as the hedge funds. So when they are looking to, for example, invest in a company, they also are looking for indications, and they use a VWAP as well. So therefore, it could be a good indication also for you when you are building a portfolio. When you have, for example, you saved some additional money, and you see that, for example, on Microsoft at the moment it is cheap because the price is below the VWAP. Therefore, you could invest some money in it. And if you would, for example, see that you have some money, but all the stocks that you are interested in are way above the VWAP, therefore you would not buy that stocks. You would just wait for a right opportunity for you. So that is as for the building portfolio and the trading mid long term. And yeah, as we talked about, of course, previously, for day traders, so you use it as the confirmation of the trend direction. So it works the opposite way when you look it in the intraday perspective. When the price is above VWAP, this is a confirmation for you that the trend is there is a uptrend, and when the price is below, it's a confirmation for you that there is a downtrend, right? Okay, so let's go for the strategies, and let's go for the strategies and to talk about how you can use it in practice. So one thing we discussed, two long and mid-term possibilities. As for the short term, we need to talk about additional feature that this VWAP has, that VWAP indicator has, which is the deviation, standard deviation settings and the bands that represent it. So this is a standard VWAP. It is only one line. So in the short-term trading, in day trading, as we talked previously, you can use it as a trend confirmation. So when the price is below the VWAP and you'll see some, for example, chart pattern suggesting the continuation of a downward movement, therefore you hop on a trend to you hop on a short trade. And in the opposite direction, when the price going above is above the VWAP, you hop on a long trade. So that's the basics of the basics, but let's check those standard deviation settings. And okay, so basically, what is a standard deviation? It's a, I don't know, the simplest way it can be explained. It's a number in statistics that, for example, how much can VWAP deviate from their standard calculations. So it has additional numbers in the calculation therefore showing us the potentially how much the price could deviate from the VWAP. So I think that is basically how you can explain it, what it shows you on the chart. And the Benz multiplier, basically it multiplies that number, so it can be 2, 3, how much you want basically. So the way you could use those standard deviation bands is to simply as an additional confirmation of the trend of the price move. So if you have example like here, when the price break through this moment over here, this suggested that the price is the direction of the movement is to the upside, therefore suggesting that it went way above the deviation number, right? So thus suggesting you that there is something going on and there might be a bigger move in this direction. So when the price retested the level of the deviation, the move continued, and it would be a good moment for you to enter the market. And how you could set a take profit and a stop loss level, basically the best way to do it is to measure the correction movement, and just so based on that set a stop loss and as well as a take profit. What I have on mean is we are measuring, for example, this was the initial move, this upside wave, and this was the correction move. So therefore you are measuring the correction move. It was you are measuring this correction move. It was on 67 points, therefore 67 points, therefore you are calculating from here 67 points as for the stop loss, right? So it would be over here. Where is the horizontal line? Or no, we have the better tool, right? Long position. So we have, yes, 66, 68, okay, 67. And as for the take profit, 2R, which is 134 in this example. Okay. So basically that is one way as for trading those standard deviation bands. So I hope you get what I have on mean, and to be honest, I didn't test it out, this method. This is just purely based on what I just noticed while studying the charts when preparing for this video, and that is basically the thing that I came across fairly very often. And basically that can be just a foundation for your trading strategy. So you get what I have on mean. And for example, there are moments like this when the price go out, turns back to the boundary. Therefore, you can again measure. You can measure this distance, set the stop loss, take profit. Here again, maybe it didn't touch the deviation line, but it made the correction move. Therefore, you could again measure this distance of the correction, 32 points, set the stop loss according to that, and set the take profit. So that is the first thing, how you can use the standard deviation lines. Okay, another usage of the VWAP indicator is the combination with the RSI. So let's add it to our relative strength index, which measures the momentum to our chart. And in this strategy, the thing that I found on there are a couple of ways how to use it to combine with VWAP and the VWAP combined with RSI, but the most effective that I noticed and the one that actually noticed on a real chart, not the one that was shown in the strategy, was the signals from the divergence. What I have in mean, when we have, for example, the price above VWAP and we see the bearish divergence on the price and the RSI. So you see that there was here the price was in overbought zone, and there was this level. Then price went again into overbought zone, still above the VWAP, but the price was higher than the ones. So if we than the previous one. So if we draw the trend line, you will see that there is a divergence. The one is to the upside, this one is on the RSI to the downside, therefore meaning that the price is losing its momentum and it is time to take the counter trade. Therefore, of course, I'm suggesting that you should open a short trade position. And as for the stop loss and the take profit, of course, typical ratio 2:1. If you find yourself more comfortable, you can switch to 3:1. But as for the levels, it depends how low you will enter the market. So it will have to be, of course, above this candle. So it will have to be above this candle, and from this moment you measure the place from which you entry to your stop loss, and then multiply it by 2 or 3, as I said in a second. So that's the first example. Let's search for another one, maybe on the other side. Okay, as for the opposite direction signal, we have the moment here when, for example, the price was trading below the VWAP. We have in this session the first moment when we went down below the 30 level on the RSI. The price went down, we touched the 30 RSI line, therefore it creates for us this bullish divergence, right? The RSI was indicating upward movement and the price was trading to the downside, therefore suggesting us the possible entry for a long trade, as for the stop loss and the take profit, same as previously. Of course, it will depend on the moment which you enter the market. Stop loss below this lowest point, with this candle, and calculate the moment from which you enter the trade, multiply that by 2 or 3 depending on your approach and your risk tolerance, and therefore set your take profit. So if you, for example, enter here, you measure this distance, right? So it is 42 points, so 84 points as for the take profit. So yeah, that is basically it as for the strategies and that usage of this in day trading. Maybe let's go back to our presentation. So let's summarize it. What are the pros of this indicator? So basically, and this is the way I am most often using the VWAP, is while building a long-term portfolio and for determining the entries for mid-term trades when I am looking for entry for a week or a couple of weeks or even month. With the mid-term and long-term approach. As for the day trading, it is more accurate than the simple moving average line, because as we spoke before, it has the volume ingredient in calculation. But as any other things in life and in trading, it has also its cons. There is not always sunshine and rainbows, and the biggest con of this indicator is that it is calculated by with the historical data. So therefore it is a lagging indicator and it will very often send you false signals. Therefore, how to eliminate them is to use them for long-term and mid-term trading, as I as I mark that over here, that long term is better usage compared to day trading with this indicator. But as you saw, it also can be used in day trading, and if you dig down how to better use it and how to spot the false signals, therefore it could be a very good indicator for your day trading strategy. So the last thing that I wanted to mention, yes, because this is the end of the presentation, the last thing is that you shouldn't use it while trading on a currency, on currency pairs, because it has the volume ingredient in it, and as you most probably know, that it is hard to get. It is impossible to get all the volume of the Forex trading, because the Forex is traded in many banks. There are not only the spot transactions that you can see, that the spot market that we are trading on. There are also internal bank transactions. There are other products like FX swaps, FX options, and I will show you on this graph. These are the data from the Bank of the International Settlements from Switzerland, and you can see that for example, these are the newest data from 2019. The spot transactions were 30%. So you can see that it is only 30% of the market. If you will be, I don't know, somehow you will gather all the data from all of the liquidity providers, all the banks, so this will be this will be only 30% of the whole market. And you have here the FX swaps, 47%, currency swaps, and options and other products. The next thing is that, for example, if you go for the counterparty, so you see that for example, reporting dealers are 38%, non-financial customers are 7%, and other financial institutions are 55% out of this. And if you break down, if you go deeper, you break down those institutions, 24% out of this 55% are non-reporting banks. So therefore, I know that there are a lot of studies that, for example, tick volume and other volumes can mimic the overall the overall market situation, overall demand which is on the market and stuff like that. But trying to solely depend on it, or mostly depend on this volume as for the trading currencies, is very can be very frustrating, and I do not recommend that. The volume, real volume, which you can get from the exchange, because the exchange gathers all the information from all the dealers, all the brokers, which are trading this particular stock, and the volume that you have from there, it is a real and accurate volume. So with that information, I am ending this video. Thank you for watching, and just follow for more, and see you in the next one. Take care, bye.